Welcome back to the deep dive. Today we're taking a targeted look at a certification that's really becoming the gold standard for global financial stability.
We're talking about the Financial Risk Manager, the FRM.
Exactly. And it's conferred by the Global Association of Risk Professionals, or JRP, and it's the benchmark for people who really get the huge, often invisible risks in modern finance.
And, for anyone who thinks this is just another paper qualification, you need to understand the rigor right from the start.
Right.
Our mission today is to give you a kind of strategic roadmap, because this isn't just about passing tests, it's about navigating a really high-stakes, multi-year process.
So we're breaking down the whole thing.
The entire three-step sequential journey, yeah. We'll dissect the different challenges of Part 1 versus Part 2, and crucially, map out the logistical details and the deadlines you just have to manage perfectly.
Because if you're managing financial risk for a living, you had better start by managing your own certification risk. I mean, we are talking about pass rates that are tough.
Oh, they consistently challenge candidates. Part I hovers around, what, 55%?
55, yeah. And Part 2 is actually a little lower, closer to 52%. So this is designed not just to test what you know, but how you synthesize it under some serious pressure.
And that path to certification is strictly sequential. It's structured like a portfolio of risks you have to mitigate yourself.
Academic, career, logistical.
Exactly. Stage 1, pass the FRM exam, Part 1. The Stage 2 is passing Part 2. And the academic clock starts ticking right away. You have to pass Part 2 by December 31st of the 4th year after you pass Part 1.
Okay, so 4 years to clear the academic side. That sounds manageable. But then NABAR introduces a level of severity that is, it's almost unheard of in other charters. This is the ultimate career deadline.
It really is. The final, and I'd say most severe stage, is submitting 2 years of relevant full-time professional work experience. In financial risk management, of course. Now, since May 1st, 2025, candidates have been given 10 years to submit this experience after passing Part 2. 10 years sounds generous, but here is the catastrophic risk.
What happens if you miss that final submission date?
The consequence is absolute forfeiture. If you fail to meet that deadline, even if you spent nearly a decade working in risk, you forfeit all of your exam passes.
All of them?
All of them. You have to re-enroll, pay all the fees again, and restart the entire process from Part 1.
Wait. So you could pass both of these grueling exams, spend, say, 8 years working in the field, and then lose the entire thing because you didn't file the paperwork on time within that 10-year window.
That's it.
That's not just failing an exam. That's like a structural penalty on your whole career. Why is it so extreme?
Well, it ensures the designation stays relevant to current practice. GARP isn't interested in awarding the charter to someone whose knowledge is 10 years out of date.
That makes sense.
It forces you to proactively manage the convergence of your professional and academic timelines. The lesson is you need to approach your career planning with the same rigor you apply to calculating derivatives.
A tough lesson indeed. Okay, let's move to that first major hurdle, Part 1. We're calling it the quantitative gatekeeper. What's the basic structure of this 4-hour test?
Part 1 is 100 equally weighted multiple-choice questions. It's all computer-based. And its core purpose is really to test your foundational analytical and quantitative tools.
The tools.
Yeah. Think of Part 1 as the mathematician's exam.
And despite that slightly better pass rate, you hear from so many candidates that Part I feels harder than Part 2. If it's only 4 topics, why is it so difficult?
It's the sheer concentration. It acts as a really severe quantitative filter. By focusing so intensely on just those 4 areas, there's way less margin for error in your calculations. You have to be fast and you have to be accurate.
So let's talk strategy then. Where should candidates be focusing their quantitative firepower?
You absolutely have to master the critical 60% core. Financial markets and products, that's 30% of the exam.
And that's all about forwards, futures, swaps, options.
All of it. And the other 30% is valuation and risk models. Together, they demand mastery of some advanced modeling nuances, things like derivatives pricing and calculating value at risk, VAR.
And for anyone listening who might need a quick refresher, what is VAR in plain English?
VAR, or value at risk, is, well, it's a statistical measure. It summarizes the maximum expected loss over a set time period at a given probability level. It's the foundational number that risk managers take to the board.
Got it. And what kind of personal time commitment are we talking about here, just to clear this one quantitative hurdle?
The average successful candidate, they're dedicating between 275 and 300 hours.
Wow.
But if you don't have a recent rigorous quantitative background, say you haven't touched calculus or advanced stats in years, That commitment can easily stretch to 400 hours.
400 hours, that's not just study time. For a lot of people, that's 6 full weeks of annual leave, gone, just to clear the first gate.
Exactly.
So once you survive that quantitative gauntlet, you move on to part 2, which you've said is a huge conceptual leap. Still 4 hours, but the structure's different, only 80 MCQs.
Right.
If part 1 is the mathematician's exam, what's part 2?
Part 2 is the risk manager's exam. The focus shifts from testing foundational tools to testing the practical application and integration of those tools.
So real-world scenarios.
Exactly. Across different risk silos. The questions are longer, they're scenario-based, and they require synthesis, not just calculation.
Okay, so if there are fewer questions, you'd think it would be easier. But the pass rate for part 2 is historically lower. What's driving that?
It's the breadth. Part 2 is challenging because it demands that you rapidly shift your analytical focus between 6 very diverse knowledge domains. You can't just be a math wizard anymore.
You'll have to be a conceptual generalist.
That's a great way to put it.
So let's break down those 6 domains. What are the 3 main pillars, the 20% ones?
Okay, so you have market risk, which builds on the modeling from part 1. Then there's credit risk, which is highly technical. It covers advanced topics like CVA and DVA credit and debt valuation adjustments.
And what are those exactly?
That's how banks account for the risk of a counterparty defaulting, while also factoring in their own credit quality. It's complex stuff.
And that third 20% pillar is operational risk and resilience. This is where the math kind of stops, right?
Correct. Operational risk is the managerial, the qualitative pillar. It covers all the non-financial risks. Think model risk, cyber risk, specific governance frameworks.
Governance frameworks, like the ones stipulated by Basel III. For our listeners who might not be in regulatory compliance, what's the relevance of Basel III here?
So Basel III is the global regulatory standard. It's about bank capital adequacy, stress testing, market liquidity risk.
Okay.
Its relevance here is that it provides the practical, mandated structure for how a risk manager has to implement the frameworks that protect their institution. Operational risk is basically testing your ability to follow those rules.
So part 2 forces you to jump from calculating complex credit risks to memorizing qualitative governance structures dictated by global policy.
Okay, I see the difficulty now.
It really is about that conceptual synthesis. And we can't forget the other 40%. You've got liquidity and treasury risk at 15%, risk management and investment management at 15%, and then the final strategic 10%.
Current issues in financial markets.
Yes.
That's the 10% where the curriculum basically meets the headline.
Precisely. It's the most dynamic part. It changes every year, and it really rewards candidates who stay on top of financial news, geopolitical shifts, emerging tech risks. It ties everything directly to a practitioner's desk.
And I imagine it forces you to apply concepts from both parts to totally new situations.
Oh, absolutely. Things like digital asset volatility, that's a perfect example.
Now, conquering 400 hours of study takes resources. Let's talk about the financial and logistical risks. First, the money. How can candidates mitigate the costs?
Simple financial prudence. You have to prioritize the early registration window. The fees vary a lot based on when you sign up. And the savings are significant.
They are. If you capitalize on early registration, you'll save about $200 per exam part compared to standard registration.
So hitting that early registration deadline for both Part 1 and Part 2 saves you a guaranteed $400. That's enough to buy a good set of study materials.
For a very, very small vacation, yes. Time management equals cost management here.
Okay. Now, moving to exam day itself, the calculator gate. This is an absolute non-negotiable policy that trips up a lot of people.
It really does. Only 2 specific models are allowed.
Which are?
The Texas Instruments BA2+, and that includes the professional version,
Mm-hmm.
and the Hewlett-Packard 12C, including the platinum version. No exceptions.
No fancy graphing calculator.
Absolutely not.
Yeah.
And given that Part I averages about 2.4 minutes per question, you need to be completely proficient with your calculator. And bring spare batteries. Seriously, your speed with that tool is part of the test.
The administrative rigor is just as tough as the quantitative rigor.
Yep.
What are the absolute non-negotiables for getting into the exam room?
You need 2 things. First, a valid, original, non-expired, government-issued photo ID. And the name must match your registration exactly.
And the second?
A printed confirmation of appointment email. If you show up with a digital copy on your phone, you will be turned away.
Wow. And let's talk about that final, most anxiety-inducing rule, the phone policy. You do not want to fail because of this.
This is the ultimate operational risk that GARP makes you manage perfectly. Your phone must be in a designated locker. But here's the key part. It has to be turned completely off.
Airplane mode isn't good enough.
Not even close. If that device makes any sound, a text alert, a vibration, a ring, while it's in that locker, you will be immediately dismissed. Your exam will not be graded.
Imagine spending 400 hours studying, getting through all the math, and losing it all because your mom texted you from a locker down the hall. That is a harsh lesson in non-financial risk.
It ensures integrity, and it tests whether you can follow the strictest operational guidelines under pressure.
So we've covered the entire journal. To wrap this up, let's summarize that fundamental strategic difference in difficulty that you, the listener, really need to grasp.
I think the core difference is focus versus integration.
Hmm?
Part 1 is challenging because of the depth and concentration of the math. It's the quantitative hurdle.
Right.
Part 2, on the other hand, is difficult because of its sheer breadth and the need for conceptual synthesis. It demands you integrate all these diverse risk silos, from calculating technical credit risk like CVA/DVA to applying qualitative operational risk standards like Basel III.
And you have to pull it all into one coherent managerial framework.
Exactly.
This really sounds like work that's comparable to an advanced degree. How is the certification actually regarded globally?
Well, independent benchmarking studies have actually found the FRM certification to be comparable to a master's degree standard.
Really?
Yes, in 14 different national and regional educational systems. That includes major financial hubs like the US, the UK, and India. It truly is viewed as an advanced degree equivalent in terms of demonstrated knowledge.
That definitely solidifies the intellectual weight of this thing. Okay, finally, we noted the curriculum is revised annually and that 10% current issues section often foreshadows new core topics. Given that dynamic nature, what should candidates be thinking about right now as the next big shift in risk?
It means that paying close attention to those contemporary trends, digital asset risk, geopolitical volatility, new ESG mandates, it's not just prep for 10% of the exam, it's preparation for the future demands of the financial industry itself.
So that section is a preview.
The current issues section is literally a forecast of risk management's next frontier. Mastering that content gives you a competitive advantage that lasts long after you've earned your charter.